Hello everyone, I'm Kabir Chandra. In this video, I'm going to talk about Bollinger Band and range guide. In part 1 video, we have discussed the importance of EMAs 5, 7, 20, 50 and 200 and how their sequence alignment helps confirm the trend condition. I also covered how the slope of these EMAs helps in understanding market momentum. A steep slope indicates strong momentum, while a flattening slope can signal a potential slowdown or reversal. Also, the weightage of EMAs, bigger the EMA, stronger the support or resistance. We also look at practical examples with real charts to apply these concepts. If you have not watched part 1 yet, please check it out. Before diving into Bollinger Bands, let me first explain the concepts of buying zones and selling zones, which I mentioned in part 1 of the video. Some of my friends have asked me why and how I mark these levels. Let me clarify that now. This is the candle which I have marked as a strong selling zone. It is obvious that this candle is significantly larger than the neighboring candles. In Japanese candlestick patterns, it is called a marubozu. Some traders refer to it as a masa candle, while others call it as an institutional candle. The reason I consider this a strong selling zone is that such a large candle often indicates aggressive selling by institutions, big banks or fund managers. This kind of move involves thousands of crores, and only those big players have the capacity to execute such massive orders. They analyze the market thoroughly before making these moves by using the best information and advanced software. When a candle of this size appears, it usually signals a sudden shift in market sentiment, leaving behind an important sell zone that acts as a potential rejection zone in the future. After this big red candle, the price moves downward, breaking the previous swing lows and support levels. This confirms the strength of the selling pressure. So now this is the selling zone. In the smart money concept, we have a fair value gap here. In later videos, I will explain what a fair value gap is and how to mark it. I also mark this level as a buying zone in part 1 of the video. The concept is the same as what we explained for the selling zone. This is a big green candle. It represents the footprint of big players. Additionally, it contains a fair value gap and shows sign of aggressive buying with a stack imbalance. That's why I mark this level as a potential buying zone. I hope this explanation clears up any doubts about the buying zone and the selling zone mentioned in part 1 of the video. That's the recap of part 1. If you haven't watched part 1 yet, please check it out. Bollinger Bands is one of the most widely used technical indicators in trading. The reason traders love Bollinger Bands is that they are simple to use but provide a lot of valuable information about market conditions. If you are a breakout trader, you can use it. If you are a reversal trader, you can use it. If you want to enter after a pullback, you can also use it. Imagine how useful it is. Bollinger Bands helps us understand price volatility, identify potential reversal points, sideways or range-bound market, and even spot strong breakouts. Bollinger Bands consist of 3 lines. The middle band is usually a 20-period moving average, which helps track the average price over a certain period. The upper band and the lower bands are placed above and below this moving average, and their distance from the middle band is based on market volatility. When the market is highly volatile, volatile means price is moving up and down with strong momentum. During this time, the bands expand or widened. On the other hand, when the market is in a low volatility means price rotating within a narrow range. During this time, the bands contract or squeeze together. This expansion and contraction of the bands is an important feature because it helps us understand the strength of price movement and whether a big move might be coming. In simple terms, Bollinger Bands serve as a flexible boundary around price action. When the price approaches or touches these bands, it often signals key trading opportunities. Whether you are looking for a reversal, a breakout, or a pullback entry, depending on your setup. But before diving into the strategies, let's first understand how Bollinger Bands behave in different market conditions. In a strong uptrend, price tends to stay near the upper band, and pullbacks often find support near the middle band. In a downtrend, price stays closer to the lower band, with pullbacks facing resistance near the middle band. When the market is moving sideways, price frequently oscillates between the upper and the lower bands, making them useful for identifying potential reversal points. When the Bollinger Bands contract, it indicates low volatility and a calm market. During this phase, the price tends to consolidate or rotate between the upper and the lower bands for some time. This often happens before a significant price move. After that, when the bands start to expand, it signals increasing volatility and an active market. This usually happens after a squeeze, as low volatility periods tend to be followed by high volatility movements. Understanding these behaviors helps in making informed trading decisions. Let's discuss the two key ways to interpret Bollinger Bands for trading setups. When the price touches or moves above the upper band, it may indicate that the market is overbought and could make a pullback or reverse. When the price touches or moves below the lower band, it may indicate that the market is oversold and could make a bounce back up. This concept or approach works best in range-bound markets, where price moves up and down between support and resistance levels. In trending or momentum market, price moves outside the bands and keeps continue moving. If the price breaks above the upper band with high volume after a squeeze, it could signal a bullish breakout and the start of an uptrend. If the price breaks below the lower band after a squeeze, it could signal a bearish breakout and a downtrend is started. This method works best in trending or high volatility markets, especially after a Bollinger Band squeeze. The mean reversion. Here we have a big red candle that breaks the previous swing low. Should we enter a short position? Let's analyze. At this level, looking to the left, we are at a support level and there is also a big green candle. Therefore, entering a short position here is risky. Let us add Bollinger Band. Okay, we see that the price went below the Bollinger lower band. As we have discussed earlier, this is an indication of possible oversold condition, so we don't take the short entry. Let's go to the settings, scroll, and check Bollinger Band break. Here we see a green dot. This means the price has broken outside the lower band and then moved back inside. This indicates a reversal or a pullback. Okay, the price bounced up. This could be a mean reversion as it moves back to the middle band of the Bollinger Band. Shall we take a short position here? Let's analyze. The previous down move appears strong, which we can consider an impulse move. So let's measure how much the price has retraced. The price has retraced exactly in between 50-60%. We now have a confluence of the Bollinger middle band and the Fibonacci 50-60% retracement. The odds of winning have increased, but look at these two big green candles. It looks riskier, so let's wait a little longer for the next candle. Okay, the down move has started. Let's take our short entry. We'll place our stop loss just above the previous high or above the middle line of the Bollinger Band. Our first target is the previous swing low. Can we expect more downside? Yes, because the previous support level has already been mitigated. Once a support level is mitigated, the next time price reaches it, it can break easily. So let's target the next Fibonacci level. Alternatively, we can use the AB equals to CD pattern. Let's measure the first impulse move and project the same distance for the next impulse move. Here we have a Bollinger Band squeeze. We wait for an opportunity to track the Bollinger Band expansion. Price is holding around the upper band and the band is starting to expand slightly. Draw a reference level at the previous resistance and wait to see if a breakout occurs. Here comes the breakout candle. A small rejection at the top or a pullback is normal. We place the entry and set the stop loss and target with a risk to reward ratio of 1:2. Range guide. I've been using this indicator for about 5 years now, and in my experience, it works best in trending markets. It helps in identifying pullback entries and understanding the overall trend direction. However, in a range-bound or sideways market, where price moves within a confined zone, this indicator can still be useful for scalping small points. The upper and the lower band act as dynamic support and resistance levels, helping to spot potential reversal areas. By understanding how price reacts around these bands, we need to adapt our approach based on market conditions. When the middle band color changes from red to green, it signals a shift from a downtrend to an uptrend. In an uptrend, the middle band remains green, and I wait for a pullback to either the middle or lower band to look for a bullish entry. Before entering a trade, I always check for confirmation, whether through candle patterns or confluence with other indicators. On the other hand, when the middle band changes from green to red, it indicates a shift from an uptrend to a downtrend. At this point, I start looking for selling opportunities. I wait for a pullback to the middle or upper band. And just like with the bullish trades, I confirm my entry using candle patterns or confluence with other parameters before taking a trade. In this video, we covered two powerful tools, Bollinger Bands and the range guide indicator. We discussed how Bollinger Bands help identify overbought and oversold conditions, as well as breakouts. We also explored how the middle line of the Bollinger Bands can act as a pullback entry point in trending markets. Then we went over the range guide indicator and how it helps confirm trend direction, showing key pullback zones for potential entries. Let's remember, no single indicator is perfect on its own. Combining these tools with price action and other confluences can improve our trading decisions and entries. If you haven't watched part 1 yet, please have a look. The link is in the description. In my next video, I'll be covering price action, market structure, order blocks, selling zones, buying zones, and fair value gaps. If you found this helpful, don't forget to like, subscribe, and leave a comment. See you in the next one.